What happens after you've seen peak inflation? So work through it with us. Have we seen that? What happens next?
Well, I think that if you look at the history for markets, at least, when you get peak inflation, you do tend to get a recovery in risk assets. And that's generally because it starts to alleviate pressures on interest rates. By that stage, you've usually had markets already pricing in an economic downturn. So at the point where people think that things are bad but getting less bad, you tend to get a recovery. But it's important to say that there are variations around this theme. After all, when inflation peaked in 2001, markets were still falling because of the fallout from the tech bubble. And similarly, that was true around the financial crisis. So I think we've got to be a little bit circumspect about this. Generally, I think if inflation peaks, it will provide some relief, but there's still the ongoing uncertainty about the scale of the slowdown in growth. And until we get more evidence that the rate of deterioration there is slowing, I think markets will be a bit volatile in the short run.
Peter, paint a picture of how corporations adapt, not sector to sector, but as a general statement, giving new, almost jump condition move in inflation. How do corporations adapt and adjust?
Well, I think there are two things that are important to say. One of them is that, inflation is generating higher nominal GDP. In a sense, growth is not the problem. To your point earlier, Tom, the problem is margins and bottom line. Equities, companies are making a claim on nominal GDP growth. Nominal GDP is actually quite high relative to the last decade. The question is how they can cope with higher costs, what that does to margins, what that does to earnings and the bottom line and their valuation. I think the second point to mention is that we're in an environment now which is very different to the one we've seen in the last couple of decades, when both commodities and labor were easily available and relatively cheap. And now we're in an environment, probably structurally, where both commodities are becoming more scarce, more heavily contested and competed for, more expensive, and labor as well. I think what that will do is encourage more companies to invest in greater efficiency, like we saw in the 70s, more spending on innovations to become more energy efficient and substituting, to some extent, technology for labor as well.
Peter, how does this all play into being overweight both equities and cash, which doesn't seem to make sense, given the fact that you see bonds as actually being the biggest underperformers here?
Yeah, I mean, in a short-term horizon, we're actually neutral of equities, overweight for cash and commodities. On a 12-month view, we are actually overweight for equities. And I think it's important to emphasize that relative to bonds, there's still some reasonable return, I think, to be got in equities over a 12-month horizon. First of all, valuations have come down a lot. Actually, profits have held up so far very, very well. If you look at most equity markets, they're trading now below long-run average valuations. That's true across Europe and across Asia and EM. Not true in the US. The US is still trading above its long-run average valuations. But I think there are some, attractive valuations that are coming through. Earnings, we think, will grow with stronger nominal GDP, albeit at a slower rate. The problem is valuation, because obviously with higher inflation, higher interest rates, you're not seeing the valuation expansion that investors got used to in the last cycle. So I think taking those things together, on a 12-month view, we think there's some good opportunities in equities now.